$333,000. That is all you can have in assets, and still get the full age pension as a single homeowner in Australia right now. For a couple, it is $499,000 combined. And from the 1st of July 2026, both of those numbers just changed. Here is the thing that surprises almost everyone. A huge number of Australians who are either on a reduced pension or getting no pension at all actually qualify. They just never checked, and the difference between checking and not checking can be worth thousands of dollars every single year for the rest of your retirement. So let us go through exactly how this works. The new July 2026 limits. What counts as an asset and what does not. How the assets test and the income test work together, and a few things you can legitimately do right now to make sure you are getting every dollar you are entitled to. Right, let us start with the basics, because Centrelink actually runs two separate tests on you, an assets test and an income test. And here is the part most people do not realize. They pay you whichever one gives you the low amount, not the higher, the lower. So understanding both is not optional. It matters. The assets test first. From the 1st of July 2026, if you are a single homeowner, you can hold up to $333,000 in assessable assets and still receive the full age pension. That is up from $321,500 last financial year, an increase of $11,500. For a homeowner couple combined, the full pension limit is now $499,000, up from $481,500. Now, if you are a non-homeowner, the limits are higher, because Centrelink recognizes that you do not have a home as a safety net. A single non-homeowner can hold up to $600,000. A non-homeowner couple combined, $766,000. Actually, wait. Let me make sure this is clear before we go any further. Your family home, the one you live in, is completely exempt from the assets test. It does not matter if your home is worth $500,000 or $2 million. Centrelink does not count it. What they do count is everything else. Your super balance once you reach pension age. Your bank accounts, shares, managed funds, investment properties, vehicles, even household contents. All of that goes into the calculation. Here is something that catches couples completely off guard. If your partner is under 67, their super is not counted in your assets test at the moment. The day they turn 67 though, that entire balance becomes accessible overnight. A couple who thought they were comfortably under the threshold can suddenly find themselves significantly over it, just because of a birthday. If you are in that situation, the time to plan is before that birthday, not after. Now, what if your assets are above those full pension limits? That does not mean you get nothing. This is the part that surprises almost everyone who watches this channel. The part pension does not cut off until your assets reach a much higher number. For a single homeowner, the part pension continues all the way up to $733,500. For a homeowner couple, it goes up to $1,102,500 combined. Let me say that again because it genuinely changes things for a lot of people. A homeowner couple can have over $1 million in accessible assets and still receive at least a part age pension. And that part pension, even a small one, is not just about the money. It unlocks the pensioner concession card, which gives you access to cheaper medicines, bulk billing, council rates discounts, energy concessions. The total value of those benefits adds up to thousands of dollars a year on top of the pension itself. So if you have assumed you earn too much or own too much to qualify, please check before you write yourself off. Now let us talk about the income test, because this is where the second calculation happens and many people miss it completely. Centrelink does not just look at what you earn. For financial assets like your super and bank accounts, they apply something called deeming. And deeming is important to understand. Instead of checking what your money actually earns, Centrelink assumes it earns a set rate. As of July 2026, the first $66,800 of a single person's financial assets is deemed to earn 1.25% per year. Everything above that is deemed at 3.25%. For couples, the lower rate applies to the first $110,600 combined. Why does this matter? Because deeming means your actual investment returns are irrelevant to Centrelink. Whether your money earns 1% or 6% in the market, they calculate a fixed assumed income from it. And that deemed income is what goes into your income test. The income-free area from July 2026 is $226 per fortnight for a single person, and $396 combined for a couple. Below those amounts, your pension is not reduced at all. Above them, it tapers. A single person's pension reduces by 50 cents for every dollar over that threshold. For a couple, 25 cents each for every combined dollar over. The cutoff point for the income test is $2,627.80 per fortnight for a single person, $4,016.80 combined for a couple. Beyond that, the income test reduces your pension to zero. Here is the part most people never think about. There are legitimate things you can do right now to improve your position under both tests, and none of them involve hiding assets or doing anything questionable. These are strategies the system was designed to allow. The first one, and this is something most people genuinely never check: gifts. You can give away up to $10,000 per financial year and $30,000 over any rolling 5-year period, without Centrelink counting it as a deprived asset. Above those amounts, the gifted money still counts as an assessable asset for 5 years. But within those limits, gifting to family members reduces your assessable assets without penalty. The second one is your home. Your principal home is exempt. That means spending money on renovations, paying off a mortgage, or prepaying certain expenses reduces your assessable assets while improving your actual life. A homeowner couple sitting just above the full pension threshold might find that a kitchen renovation or a new car brings them back under it. The third one is funeral bonds. Prepaid funeral arrangements and certain funeral bonds are exempt from the assets test up to specific limits. It is not a huge dollar amount, but for people close to a threshold, it is worth knowing. And here is the one that surprises almost everyone. Before you turn 67, your super in accumulation phase is generally not counted by Centrelink at all. Not in the assets test. Not in the income test. That changes the moment you reach pension age, which means the years immediately before you turn 67 are genuinely critical for structuring things properly. Decisions you make in that window can affect your pension entitlement for years, even decades. The practical steps you can take this week are straightforward. Go to servicesaustralia.gov.au and use the free payment and service finder. It gives you a rough eligibility estimate without requiring you to enter personal details. Takes about 10 minutes. If you are already receiving a part pension, contact Centrelink directly and ask them to reassess your entitlement under the new July 2026 thresholds. The thresholds went up. Your pension may have gone up too, but Centrelink will not always reach out to tell you that automatically. And if your situation is even slightly complex, a partner approaching 67, investment properties, and SMSF, it is genuinely worth getting proper advice before you make any moves. The rules interact with each other in ways that are hard to see without modeling your specific numbers. This is exactly why we make these videos. The information is all publicly available on the Services Australia and ATO websites. But those pages are long, technical, and honestly quite hard to read if you are not familiar with the terminology. We go through it for you, translate it into plain language, and make sure you know what questions to ask. Subscribe to SuperEase Australia if this helped you see things more clearly. Every video on this channel is built specifically for Australians in this stage of life. Real figures from real government sources. Nothing made up. Nothing exaggerated. And drop a comment below. Just tell me this. Are you currently receiving the age pension? Still waiting to qualify? Or somewhere in between? 2 seconds. No personal details needed. It helps me know exactly what to cover next.